All right, ladies and gentlemen, welcome to the session here. It's Rodrigo. I'm going to be here with Matt Malley, Chief Market Strategist at Miller Tabak, lead trader, mentor, educator at the Stock Picks Inner Circle chat room. A lot of you guys have seen him either on CNBC, Bloomberg, interviews all over the place. But he's going to be here with us today for an hour or so too. And if you do want to follow Matt a little bit more, feel free. We do have a live trading room. Matt is going to show you how he has been trading and profiting from the volatility in the markets. So big shout out to you guys, G Pastor, M Sorrow, M Rosso, I think that's Melissa, what's up? Richard Robinson, good to see you here. Vivian Fele, okay, we got a nice crowd, folks. So in the chat, let me know when you guys are good to go. But basically, we're gonna be talking about trade ideas from Matt's chat room, education, live trades, technical analysis, market discussions, events, and how to profit from what's happening, right? There's a lot of stuff that's happening. It's important to know. More importantly, how you can profit from the volatility. So without further ado, let's go ahead and bring on the man himself, Matt Malley. Make sure all's good here.
Okay.
What's up, Matt?
All right. going on, Rodrigo? Can you see me okay?
Yeah, man. And by the way, killer trade, man, on Friday. I'm gonna just be honest here, man. That chat room has been so good to me, man. So great trade. But there's a lot of stuff happening, man, in the chat room. And it seems like the crazier things get out there, it seems like more opportunities come to the chat room, right?
There's absolutely no question. I mean, there's so much going on in the world today. I mean, we have obviously what's going on in the marketplace with the Fed tightening and inflation, which this whole thing with inflation was a big problem at the end of last year. People were worried about it, but then with the invasion of Russia of Ukraine, and now that is quickly, or it's become a war of attrition, which means the sanctions are going to be in a long, long time, and prices of the two most important things in the world, food and energy, are going to remain high for quite some time. That's going to be a big problem. Then, of course, we have a situation in China. They have lockdowns, but then, of course, and then this weekend they warned the U.S. about sending any military boats into the Straits of Taiwan. So there's all sorts of things that keep popping up. Now we see Bitcoin starting to get hit. Volatility is going to be with us for quite some time. So it's a great opportunity to be an active trader, and we've been profiting very, very well from it so far this year, and I think we'll continue to do the same.
Matt, you know what's really funny? Remember, as we do these sessions, remember when we were talking about that, like the possibility of things getting riled up there, just adding a little more craziness to the markets. It's just, you are, just for the folks that don't know, I mean, you are a global equity strategist, right? So you look at global markets, and you've been around Wall Street for 40 years. You've been at Merrill Lynch, head of trading, Salomon Brothers. You've pretty seasoned trader and analyst side. So can you tell us a little bit about that for the folks that are not familiar?
Yeah, I had, my background was in trading, where I'm chief market strategist at Malley and but for most market strategists and economists, for that matter, most of them, economists, most of them spent time they were spending time on a trading desk. They spent time in the classroom, and they learned the theoretical. They learned about what should happen, not what will happen. And and their theory has always been the market is always right. Well, the market is only always right eventually. And for active traders, it can be the fundamental outlook could be one way, and the market could go the exact opposite way for a short period of time. And there's a lot of tools that I learned as a trader for 25 years. Again, I was at Salomon Brothers for 15 years. That was the biggest trading desk for the last 3 decades of the 20th century, the 70s, 80s, and 90s. I was there for 15 years in the 80s and 90s, and then moved on to Merrill Lynch. And working on those trading desks, I covered the biggest institutional trading desks in the world. I mean, the biggest mutual funds like Fidelity, the biggest hedge funds like BlackRock, huge banks, huge insurance companies, et cetera, et cetera. And these were the kinds of things that enabled me to look at the broader market, not just look what should happen. Obviously, the fundamentals are always very, very important, but most strategists, that's all they look at. They don't look at sentiment. They don't look at a technical analysis. They don't look at positioning. And it's just something where I've been able to kind of bring all these, look beyond the fundamentals, bring all these things together to time the market. Nothing's perfect. We've certainly had some bad trades, but we've had way more good trades. And not only that, the good trades make a lot more money than the ones when we lose money, because we use good, risk management, so that we can, try to make those ones that lose money and limit the losses there, and then hit the big home runs. We've had some huge home runs and even some grand slams this year, and it's again, this high volatility environment is really helping us. And based on especially what we saw on Friday with the inflation numbers, shows that I think this volatility is going to be around for the rest of the year at the very least.
Right. And look, this is definitely a time that if you are new to trading, I definitely don't recommend to wing it right now. But I think, Matt, do you have some, let's just show, so here's the thing, right? You're a strategist, and you look at what's happening in the markets, and it's really interesting because as a trader now you can also, trade that volatility in the chat room there with the folks. So let's go ahead and show them some of these trades that you've made.
Yeah. Well, we'll start with the one we just did that you mentioned, the one we just did on Friday. Going into the, I'm sorry, here, let me just pull up my thing here. Oops, I'm sorry, I didn't put my screen share on. I apologize. Hold on a second. Oh gosh, I'm sorry. Here we go. Sorry about that. Screen share. There we go. There we go. Bang. Okay, my apologies there. And it'll just take a second to get it up. Over here. Oops. Here we go. Whoops. Here we go. Okay, now, what happened was going into the number on Friday, a lot of people on Wall Street, and it was kind of interesting because some of the chat rooms and stuff that are away from us, these great big ones with tens of thousands of people in it, where you don't really know what they're really doing or what their intentions are. We're really talking about that they thought the inflation number would be surprised to be a little bit a little bit better. In other words, not as strong, not as high, and that obviously turned out to be turned out to be dead wrong. And I really felt that was what was going to happen. So we got into the let me just okay. So we got into as we got into the day late on Friday, I'm sorry, take it back, late on Thursday, as we were setting up for the number, because we knew that the number would be coming out before the opening on Friday, before the market opened on Friday. So I was like, okay, let's take a serious look at boom. Okay, there we go. Let me just blow it up here so you can see it better. So this is here. Let me just there. Okay, now you can see it better. Okay, so what we did is I was just looking at the market saying there's a big risk here. Even though the market was down on Thursday, and it had bounced over the previous 2 weeks, and people were really getting excited about it, thinking, you heard all those stories about peak inflation, which I said were wrong, and I was correct about that. The one thing I did say is that it really doesn't matter. We're going to reach peak inflation sometime soon, but it's going to, when it comes back down, it's still going to level off at an area that is much higher than anything we've seen since the 1970s. And the market has not priced that in yet. So therefore the market's going to come down. And I really felt that we were going to get that too many people were looking for a surprise, a pleasant surprise. And I thought with that in mind, all we needed was something, a number that was in line with expectations. And if we got one that was anything worse than expectations, the market would get hit. So what we did is on late in the day on Thursday, again, we wanted to do it on Thursday because we wouldn't get the opportunity to trade these options before the market opened, because the news would come out and the market would adjust. So that's what we did. So we went in and bought the SQQQ June 10th 52 call options and $52 call options. So what it is that the SQQQ is an inverse ETF, okay, for the QQQ. So the QQQ is the ETF on the NASDAQ 100. You have the NASDAQ Composite, which has thousands of names in it. The NASDAQ 100 is the top 100 names in the NASDAQ, which is very highly concentrated in the big tech stocks. And I knew that if the market, if this inflation number was higher than expected, rates would move higher and the tech stocks would get hit hard. So we had a choice. We could buy the QQQ puts, okay, which obviously a negative bet, or we could buy the SQQQ calls. Now, what are we talking about? You're buying calls. I thought, calls are a bullish bet. Well, yeah, but we were buying a bullish bet on a negative asset. In other words, the SQQQ was not only an inverse ETF, but as a 3-times leverage ETF. So it really had a lot of juice. I really felt if the market really got hit, we would the stock market, we'd make a lot of money in this. So we went ahead and we bought these again. And whenever I put in a call, a trade, I give the exact trade. I don't just say, hey, it looks like the market's going to sell off tomorrow. Why don't you buy some bearish options, and just leave it at that. I give very specific trades. In this case, again, I give the SQQQ. That was the ticker symbol for the asset, for the stock, or in this case, ETF. The expiration date, June 10th. We were going just for the very next day because we know there wasn't a lot of time value in them in these options, so they were relatively pretty inexpensive. Then, of course, the strike price was just $52, and then, of course, I say whether it's a call or a put. In this case, it was a call. But remember, because it's an inverse ETF, a call option was actually a bearish bet. So it came in right before the end of the day. It wasn't right at 4 o'clock when the market closed, but you can see a little after 3:30, was getting into the end of the day. And actually, if we bought them at 3, we would have made even more money. But we bought them there about 3:30, a little after, and then of course we waited to see what the number was the next morning. 8:30, the number came out, and sure enough, the stocks, the market got hit hard, and we went in and we sold them. We didn't buy them at the absolute low. We didn't sell them at the absolute high. We still made 400%, okay, on these options. Now, look what we did here. So what we did is and we also, I just want to say too, is that I wasn't fully convinced, I wasn't absolutely sure that the market would sell off and cause the SQQQ to rally. So what we did, we bought a little strangle. I usually go specifically just with calls and puts. We don't get too much into the nitty, these sophisticated plays. There's nothing wrong with using those plays, and a lot of people in our chat room use them. Using iron condors and big credit spreads and things like that. Those are fine, but we usually stick to just puts and calls, directional changes, and once in a while we'll do a straddle or a strangle. And what that is he's buying what we really think is like, hey, this number is going to, something tomorrow is going to take place that's really going to move the market. In this case, we saw CPI. So what we did is we put a lot of money into some bearish bets and a very small amount of money into the bullish bets. And my thinking was, hey, if we got a really good number and the market just took off, that call option would about cover everything we spent on the bear. That bullish bet would pretty much cover everything we spent on the bearish bet. Would come out flat. But since I was really felt that we could make more money on the bearish side, it was a much bigger position. And sure enough, like I said, we made 400% on a position that was way bigger than our bullish bet. And right at the opening down here, and I was down a little bit, but I sold a tiny amount, 10% of my holdings, and that covered everything I'd spent on the bullish call. So realize like, okay, now I can't lose money. Okay, and that's why you do these straddles and strangles, where you can bet. Sometimes people buy those kind of strategies right before on a specific stock, right before an earnings announcement, because they're like, geez, this stock is going to see a big move. That's not what we always see. Sometimes the stock has been kind of doing nothing. They've pre-announced. We know what they're going to be, so you just ignore the stock and let it go on its way, because it's not going to see a big move. But there's been a lot of instances where we've been able to play it, where we see a big number when in terms of a economic number, or maybe an earnings report, a Fed meeting, whatever it might happen to be. You can play those kind of two-sided trades. But this is one where just last week we made again 400%, and so you make 4 times your money in one day. There were people here saying they were going away for the weekend in the chat room. They said, okay, man, I made my money for the day. I'm going to the beach, which is great. And you can see now as they sold off, we made a good profit. If you'd held on a little bit longer, and maybe some people did in the chat room, and that's the thing. It's not everybody does exactly what I say, but I do want to tell you, if I do a trade, you know about it immediately. And when I come in and say, I'm going to do this trade, and when I sell it, I tell you I'm getting out of this trade. And I don't wait. There's no lag time. I don't sit there and say, geez, I'm going to buy something, and if it looks like it's working after a half an hour, then I come in and tell you about it. No, I tell you about it, then I make the trade. Then and when I'm going to sell it, I tell you about it. Then I make the sale. I do not, everything I trade, you know about. Okay, I don't do trades. I was like, I don't want to tell anybody about this trade. Once in a while, I'll do small trades. I'm like, hey, this is a tiny little thing. I'm going to buy a little bit here because I think it could really move, and I'll add to it if it starts to move. But I don't, I thought, geez, should I even tell people about that? It's like, I want to be upfront. Every trade I do, you know about it, and I try to tell you how this works. But okay, so 400% trade. This is not something that has just been, we've been very consistent with some of these big trades. So that was just this past week. The week before, late in the week, again, we had the this was June 3rd. June 1st and June 2nd. Okay, now we bought the June 3rd calls, but you can see down here on Wednesday was June 1st. Thursday was June 2nd. The market was getting very, very oversold. So we went in and I said, hey, let's buy, okay, let's see if we still have it here. Okay, well, I don't have the chart, but we did go in and buy some what we call TQQQ calls, and that's just the opposite of the SQQQ. In other words, it's a leveraged ETF, but it's leveraged to the upside. So if the QQQ goes up 5%, it's going to go up 15%, and obviously his options are going to go up a lot more. So we bought some nice options on the 10th. I'm sorry, on the 1st, on June 1st, went to June 1st, and sold them the next day. We also bought some advanced micro devices June 3rd call. So again, I tell you the exact trade: AMD, advanced micro devices. The expiration date June 3rd, and the strike price $105. And whether it's a put or a call, in this case it was a call. Again, we bought them in the morning that day. Stock came down, but I still felt comfortable about it. Some people bought it even in here. They waited until the next morning, and I was really bullish on it. And sure enough, we rallied up 146% by midday. Now, the stock, this is where I sold it. I mean, I did, it even rallied even more by the end of the day. But the point is, this was, again, 140, we more than doubled our money. We made one and a half times our money in just a day. And so these are the types of things. It's not just a one-off thing. Whoops, I went the wrong way. I just showed you that. Amazon also that week, that same week, not this past week, but the week before. This is not a trade I got involved in, okay? It was funny because they asked me about it, and one of the people in the chat room was really bullish on the trade, and she got quite a few other people in the trade. They bought the Amazon. This is before it split on, just before it split, so it's still trading up above 2,000, and the $2,500 calls, okay? Look at this, they made 500%, okay, that week. Okay, this was earlier in the week. It's the same week, first, second. See, this is Monday, Tuesday, and they bought as much as 1,500%. Okay, again, I can't take credit for it. It was not my idea, and sometimes I say, hey, that's not my idea, but but it's a good one, so I'm going to go ahead and jump into it. This one I didn't. I wish I had, obviously, because it made a real good move. But my point is, in the chat room, it's not just me giving the ideas. There's only so many ideas one person can have at any given time, and we're sharing it. Well, people are putting them in there all the time. It's a great team effort. Everybody's talking to each other and giving opinions on whether this might be a good trade or not a good trade. But this is, again, another one. And then you just go back. Here, now we're looking back in May. This was the call option I was talking about. No, it's not. This was the week before. Then we go to the last week in May. We also at a time where I got bullish. Okay, this one was one where the market was getting oversold on the 25th, May 25th. And I came in and said, let's get specific trade. TQQQ, that's a bullish trade. The May 27th, $30 calls. We bought them at 1 o'clock. By the time I was like, this is too much. Double my money in 2 hours. Usually I usually don't do that much. Some of the people in the chat room do a lot of scalping where they trade intraday. My stuff is more usually for a couple of days and sometimes a couple of weeks. But this one was like, hey, I've doubled my money. I don't know how much longer this rally is going to last. And we got out right before the top, but it worked out very, very well because the market sold off at the end of the day. And but again, so that was the week before. Oops, I keep going the wrong way. Okay, now this was just earlier that week. This was the QQQ calls. Again, I didn't go in this case. I didn't go for the. What I did, there was another short-term call. This is one we don't do it as often as it may sound the way we're talking here. But here's one where the reason why is that those leveraged ETFs, they expire once a week. Okay, and whereas the QQQ, the SPY, the index, the regular index ETFs, they expire. The options on them expire 3 times a week: Monday, Wednesday, Friday. So this is a case where we could take advantage of it and buy it, and not have to go all the way up to Friday. Let's just buy them for tomorrow and see how they do, because I think this is a real good time. Sure enough, this is another one where we bought them at about 3 o'clock, at about 2:30, 2:45. And right at the end of the day, I'm like, oh my gosh, we've made almost 3 times our money, 174%. Do we really want to hold on to these till tomorrow? I said, no, you ain't make that much money. Don't get greedy. They may go a lot higher tomorrow, but when you make almost 200% on your money in less than 2 hours, we went ahead and sold them. And the point is, before I go on and show you this, what I'm trying to tell you here is that these are some of the trades we do. We don't just get them once every 6 weeks. we get these things on almost a weekly basis. And in the last several weeks, it's been every week. And in many cases, several really big trades where we're making these kind of returns. Believe me, you make 20% in a couple of days, 50%, 75%, that works out great. But before I talk about those others, and we can't, I don't want to bore you, but too much about these, give you these examples.
I don't think people know here, Matt, that Matt has the record in Benzinga for the highest percentage win trade in all of history. I think it's FXI. Some people were calling me, emailing me, blowing me up every day, but some people made up to 14,000. But Matt keep in mind, you get entries and exits from Matt, and he'll show you where he sent out the sell alerts. And
right.
This is the biggest trade ever that I've seen.
Right. This was one, again, I say we do these several times a year, but this FXI trade, let me blow it up for you here. This is a trade we did. This was back in March, and this is the FXI. Now, this is a great example of, two things. Number one, what I really want to say is that it's so important is that with this volatility, now we have the tools to do this stuff. I talk about the SPY or the QQQ. These are the large index ETFs, and they have very liquid options. They expire every Friday. The same thing with Apple and Amazon. All the big cap names, big cap stocks have weekly options. So in the old days, you used to have to go out 2, 3, 4, at least. Well, I should say that. I mean, for instance, if you wanted to buy on July 10th. You decide, geez, I really like Apple here. I want to buy some Apple calls. That's fine, but the next calls didn't expire until September. So not only did you have to make the bet, but you had to pay 3 months of time premium, and that just that's obviously the person who's selling those options. They're taking a 3-month bet. They're taking a 3-month risk by giving you the opportunity to buy that option. That's more risk to them. If they're only going out a couple of days or a couple of weeks. There's less risk, so they charge you less. There's less risk for them, less time premium, and we tend to buy a little bit out of the money. So when you do that with shorter time frames, you can make a lot more money. So we have weekly options. We have, as I mentioned, 3 times a week options for the index ETFs. On the medium-sized ETFs, medium-sized stocks, we also have those weekly options. Not all of them are really liquid, but the ones that are when they're not, we say, hey, listen, we want to avoid these ones because they're just not very liquid. But we have all these weekly options, 3 times a week options. We have inverse ETFs, we have leveraged ETFs, and many of them have very liquid options, which is you want to be able to do because we've had a couple of things to say, hey, this looks like a great idea, and then we looked at the options and realized actually these options don't trade well at all. There's big wide spread. They're very illiquid. They're just not worth staying into it because this trade might work out, but by the time you sell them all, they're so illiquid that you'll actually lose money. So, but the tools are there. This is something in 2008 and 2009 and 1999, 2000, 2001, and even in 2018 when we had almost a bear market there. These tools weren't available to us. They're available only to the biggest institutions. Now they're available to the individual investor, and we can take advantage of it. But let's go back to this FXI trade, and it goes back to what we were talking about earlier about not just looking at fundamentals. I mean, I had been negative on the China market all year and for much of last year because you see this is the FXI, and what that is that it's the large, as it says here, it's the China large cap ETF for China stocks. And again, it's a situation where 10 years ago, you would have needed a broker in Hong Kong who would be willing to do the currency transaction and then do the trade. A convoluted thing you'd have to do at 2 o'clock in the morning, and it was just too hard. Now we have these ETFs that we can do. But you can see how this market was just getting clobbered all year long. Remember, they had just one after another. They started off going after Alibaba in late 2020. But it was just every month it seemed like another sector. They went after gaming. They went after the educational stocks. They went after the retail, obviously, with Alibaba, the technology area, et cetera, every single month. And then we got this big sell-off even more this year when our own SEC came in and said they might delist some of these Chinese stocks. And it just got clobbered. And so what I did is I came in and said, even though fundamentally I don't really like these stocks right now, and they did eventually fall a little bit further, Now they bounced back in the last week or two. But I look at technical analysis. This is what's called a relative RSI chart, the relative strength index. This is Laxmi's chart. That's because it was what I used back in March. So forget about that. But this here, the RSI, when it gets down here to the 30 level, okay, that means it's getting oversold. And it gets below that, it's getting more oversold. And of course, and that's why it's a green line. It's because it's oversold. You ought to buy it. You know, it's getting ready to bounce. Go ahead and buy it. And then when it's getting overbought, it gets up to 70. That's the red line. That means stop. Don't buy anymore up here. It's getting too overbought. Wait for it to come down a little bit. Well, look how oversold this stock got. It's a 30. It gets down to 30. It's oversold. This thing got down to 14. I had only seen one other thing get more oversold in my life on this RSI chart is this. So I saw that and I said, okay, this is really looking to be a good opportunity on a technical basis. But I also knew from 40 years of experience on Wall Street that that the Chinese government, when these kind of situations pop up and their market is just going straight down, the Chinese government comes in and buoys their market. I mean, they just come in and buy their market to make sure it goes up. So I had an oversold market. We had big capitulation here, incredibly oversold, big sell-off down. So there, whenever you get capitulation, basically all the sellers the buyers just disappear. The sellers get tired, and finally it sets up for a snapback rally. But I also knew that the government would come in and support the market. So sure enough, the next day, bang, 27% rally in the China stock market, 27% in one day. Okay, this actually went out 2 days, but you can see the high of the day after was up 27%, and you can see how much it bounced up after being ridiculously oversold. And so we had gone. So what I did when we were back here, when the market was crazy oversold, we went in and we went and bought the FXI March 18th $30 calls. Okay, so we bought those on the 15th. I say March 18th, that was the expiration date, but we bought them on the 15th, late in the day, about 3 o'clock. And of course they just exploded the next day. The next day the market opened, and then woke up, they were up over 1,000%. And people were saying, geez, I should take some profits. I said, no, don't take profits yet. Again, my experience, I knew China's are going to keep buying their market. This thing's going to go higher. Don't just, a lot of times, if you're making 1,000 point by the opening, I usually say, let's just get out, take our money and run. This one I knew it would go higher. And sure enough, so it got up about 3,000%, see 2,948%. I came in and I said, okay, let's sell half. And so I sell whole, all of it. I was like, when you're up 3,000%, 30 times your money, you got to sit there and say, I got to take something off the table, even though I thought it was going higher, but you got to. And sure enough, finally at the end of the day, we came in and said, sell the balance. So almost 8,000%, almost 8,000%. Okay. And so, and then some people held on to it. Again, you don't have to do exactly what I say. I give a bunch of ideas, but you can hold on. And some people did and made as much as 14,000% return. And so I can only take credit for about 8,000%, but it worked out extremely well. And again, like we said earlier, it's not the, it's not, there we go. Okay. There we go. Good. So, oops, I went too far. Oops. Okay, so it's not. It's these big ones we have in the thousands of percent. I showed the one from Amazon earlier. This one, which has been outrageous. Last year we had one in Viacom, which is about 5,000%. Those don't come every week, believe me. They don't even come every month. And we've had more than one this year, which has been great. But we're still looking for these ones where you can make several 100% in just a very short time frame. And we've been able to do it consistently this year because the volatility has been strong, and the volatility has been incredibly high. And it's going to remain. We'll go over before we're done here today. Tell you why I think that volatility will remain high. There's a lot of things going on that's going to keep it that way.
Matt, and can you tell the folks what is the Tuesday session that you have with the members?
On Tuesdays we have, and I'll announce this on tomorrow as well. Is that I'm going to do a little bit earlier this Tuesday. I'm taking my sons to the U.S. Open practice round in the afternoon. So we're going to do it. We usually do it 11:30, but we're going to do a little bit earlier this Tuesday. But my kids are excited, so we're gonna do that. But I'll still be able to keep a monitor the markets with my phone. Anyway, 11:30. It's we do a Zoom call like this, and it lasts anywhere from a half an hour to 45 minutes, or even close to an hour. And we talk about a lot of different things. This week is interesting. We're going to talk about I forgot exactly what they asked. Somebody asked me about something, but I written it down. We talk about some fundamental things. We're going to talk about tutorial. In other words, we do a little tutoring. Sometimes we talk about technical analysis, head and shoulders patterns, whatever. Talk about that. Then we talk about the broad view of the market. We talk about and I have my Bloomberg up, and right now I've been showing you some examples from my Bloomberg, but I will also show you, I have the live Bloomberg up, which we will look at today as well.
So a lot of education, right? Even though you're providing killer trades, education is something important.
That's one of the biggest, most important things, Rodrigo, is that, because just telling you, buy this or sell that or whatever, that's fine, but don't you want to know why we're doing it? I mean, that's how you learn. And that's all. And it's like, hey, we're selling this at a loss because it's not working, and this has changed. So we're just going to dump it, take our loss, and move on to the next thing. That's so important in when you're an active trader. You are not going to bat 1,000. Anybody who claims they're batting anywhere near 1,000 is lying. Okay, and but the thing is, you don't want to be batting 300 either. I mean, batting 300 in Major League Baseball is great. We want to be batting 600, 700, 800, more than 600, 700, 800, and then making sure those hits are all big ones and the losses are small. And so that's again, risk management. So that's a big part of it. But also, try and talk about that's the issue we're going to talk about on Tuesday is Fibonacci levels. It's this with this mathematician, but it's who literally goes back 600 years. But he came up with these interesting relationships that go through not just, he wasn't talking about stock markets, and it's just all these time intervals. And it's a very, very interesting, but we talk about how it's remarkable how much these Fibonacci retracement levels work for trying to get a target on where the market or where a stock is going, especially when it's seeing a counter trend move. And so we talk about those things and say, well, why is that important? And then it sounds like a bunch of baloney to me. Well, then you show that people's like, look, I got right down to that level and stopped going down and rallied back. Holy cow, look at that. And so, but we talk about technical analysis, sentiment, positioning. It's so many times when people say, oh my, like one of the things, again, the perfect example is in China this year. I mean, I was negative on China on a fundamental basis, but I saw these things lining up for a really strong trade. So we took advantage of it. And that's why that's one of the most important things to learn that we, at least I try to portray in the chat room, is that when you're an active trader, a lot of times the best money is made when you go against the longer term fundamental trend, because it's just what happened when too many people get on one side of the boat. Apple Computer last year in 2021, the market went straight up. Apple was one of the best performers, but it still had, I know it had 3, it might have been 4 corrections of anywhere from 9 to 18%. And so, because when my point is that even when the market is going straight up in a nice straight line, certain stocks still get ahead of themselves. And we made some negative bets in Apple Computer. And it worked out very, 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 very nicely, even though it didn't make a whole lot of sense on a longer term basis. But that's what we try to show. You can make money in both directions. We now have the tools, and now, right now, especially this year, and I think in the next year or so, or even more, being able to make it in both directions is going to be the best way to trade the market. Because if you're only trading on the upside, you're going to have a tough time. We're going back to an inflationary environment that hasn't existed in 40 years, and it's already with us. Stagflation. Forget what they tell you on those financial news networks. Most of those pundits, those guests they have on, are paid to be bullish, and they get around it by saying, "Oh, we don't have to worry about recession this year." Well, that's great, because if we're having a recession next year, it's going to affect the market right now, because it's the stock market looks ahead 6 months. But they have to say that because it's not good for their job security or their year-end bonus if they're telling people that a recession is coming and they should sell their stocks. If you're working if you're working for a money manager, if you're working for a brokerage firm, most of them will not say that. And almost nobody will say they're having a recession. I mean, you see Goldman Sachs saying it's a 35% chance of recession.
They cut you off. They cut you off the thing.
Yeah.
And you start saying,
it's crazy. But now, now what they're all saying is like, well, the odds of recession have gone up a lot, but it's still not my base case. It's like, the recession is coming. Okay, maybe it's only a mild one. I don't know. But when you get a guy just look at what Jamie Dimon said. This is one of my best examples to talk about what's going on. Jamie Dimon, the CEO of JP Morgan, maybe probably the most powerful CEO in the world. And he obviously gets a whole view of the world. He sees what's going on in the marketplace, in the whole, and in the total economy, not just the U.S. economy, but the global economy. And he came in, the market was down 15%. That's down a little bit more, but at the time, the S&P was down 15%. In 2016, the S&P was down 15% as well. And people were really nervous. So what did he do at that time? He came out and with his own money, he spent $26 million of his own money to buy his stock, JP Morgan. Okay. Now, this was not a company buyback. This was his money personally for his personal trading or his personal investment account. He bought the stock. And guess what? The stock bottomed that day. The market bottomed that day. And they started rallying and they didn't look back for 2 years. Okay. So what did Jamie Dimon do this time around 2 weeks ago? Market down 15%. Did he step to the plate and buy JP Morgan with his own money? No. He came out and said, batten down the hatches. We got a hurricane coming. Okay. You don't say those things. Like I said, he'd be buying back the stock if he thought this was a great opportunity. And, we saw the same thing. One of the reasons I got very, very negative at the end of last year, I mean, I've been bearish all year long. But the CEO of Microsoft sold 2/3 of his personal holdings in Microsoft at Thanksgiving last year. Nobody sells that kind of big position unless they think the stock is going down and going to stay down for a while, like 2 years. You just don't do that. They have too much, again, he did nothing wrong. There's absolutely nothing wrong. He's a great CEO, Mr. Nadella, great CEO. He's turned the company around, got it back on top. They were a great company in the 80s and 90s. And a great company the last decade, but he brought them back, I say from the dead, but they had lost their luster. And now, unbelievable, they have great long-term prospects. But that doesn't mean their stock's going to keep going up. He saw that their stock had gotten too expensive. He saw what the Fed was about to do, and he sold it. So look what these guys, when the big insiders do something, you pay attention. They're never contrarian indicators. That's for sure.
So, so in the chat room, right, for you guys to know, even though Matt is trading calls and puts from either the QQQ or the different sorts of ETFs and things like that, we also look at other types of stocks, not just large caps. A good example of that was when we were looking, and for months we've been looking at this dollar stock, MULN, MULN, and well, Matt's been following it as well. Based on, they had a pretty good thing there with their battery from what people are talking about. So that's what everybody's waiting for, and some Fortune 500 company that they're going to announce some partnership with. So
yeah, it was the one. Well, you were the one who really pointed it out, Rodrigo. There's this company that it was trading at 80 cents, way back here. It traded to $4 because we saw it, and I certainly knew about the company. I didn't know a lot about its a lot of the details of it, but I started looking at it because Rodrigo brought it up. They had some great. So what we did is we buy some stock in here, and then when it broke above its old highs, beginning at a higher high, I said let's get more aggressive in this thing. And sure enough, the stock shot up to $4. Now, that's obviously more than doubled. If a stock it goes up 100%, just think how much the options go up. Okay, these are the types of things that we're constantly looking for. So as Rodrigo said, you don't need to buy these 30, these penny stocks that trade for 20 cents to make big money. But at the same time, if there's a stock's 30 cents, I'm usually not looking at it. I mean, there might be some special indications, but this one was one real company. Obviously, the stock was trading. You can see, the stock was trading in the teens. And it just came down when the whole a lot of those EV stocks got hit. But again, we talk about those, and people are asking me all the time, "Hey, what do you think here?" Several times in the last 6 months, what stocks do you like on a long-term basis if you think the market's going to go down for that long? And I gave some good there. Verizon was a one because it was such a big dividend payer. Chevron was another one, which has gone up 3 or 4 times. Well, I've liked that stock for 2 years now. But again, when I started recommending it, it was the stock had a 7.5% dividend yield. So you're paid to wait, and the stock's gone up several hundred%. So we're not just talking about short-term high tech stocks that move in a big way. We're talking about everyday stocks all the time, or people for their longer term accounts as well. It's like, most people should have that long-term horizon where they have that bucket of stock. It's a big bucket, and but to still have a nice sized bucket for trading and it's active trading. Again, we have the tools, we have the ability to do it now. And
Right.
if you have the time and the inclination, you can really maximize your returns. And in this case, this year, you have returns. In other words, you have profits in a year where most people have not just some losses, but some serious losses.
Right. No, I mean, it's pretty, yeah, definitely, man. With Tiger Global, everything, it's getting pretty obvious. But okay, so James Donahue from the chat says, I want to thank you guys again for the analysis. Led me to buy the June 10th SQQQ $52 calls and the UVXY, both crushed, sold on the way up on Friday. Unbelievable. So shout out to James. But we're getting a lot of questions here about the chat room. So I'm just going to get this out of the way before we can continue on here with Matt's analysis. All right, Matt, just a minute here or two.
Sounds good.
Okay, so we have, does Matt Malley go over like feedback for student trade ideas? Yes, he does all the time. The chat is a two-way street. You talk together. Are the sessions on Tuesday recorded? Yes, so if you're a chat member, you get the recordings, for those member meetings on Tuesday. Let's see. Does everybody that joined get a free laptop? Yes. Chat room schedule. The schedule of the chat room is Monday to Friday, 9 to 5 p.m. Money back guarantee, 7-day money back guarantee, and price at renewal, same as today, 70% off. It'll never go up. If you have to sign up though and keep that discount. So that covers everything. But the Tuesday sessions, I asked Matt because those have been evolving. First there were like 20 minutes, then they became like an hour. And now it's more educational for some people that ask for it. So it's a la carte, and that's really what I like. It's really has a little. It has that family-owned, family-operated feeling, right? That's how I feel about it.
Right. Yeah. That's it. And so we get some good questions, and of course they're very similar. But I'll show you here. You can see here. I just showed you. I mean, this is my Bloomberg test. So we sit there and people say, "What do you think about that? What do you think about this?" And I'll type up the stock. It's like, hey, here. Well, I'll show you right here. Let's Ethereum. Okay. Of course they keep trading over the weekend, right? Unlike stocks. And as much as I like Ethereum on a long-term basis, oops, what's wrong here? It broke below a key level last week, and it's fallen a little bit more today. But again, so this is what we do during the Zoom, and I come right back, I go into this, and we talk about it. Now it's starting to get oversold, but this is what I said last week. It's like, look at this thing. Oops, didn't mean to do that. There we go. And I said, look at this thing. This is forming what is called a descending triangle pattern. And oops. There we go. So this was, this was before it fell out of bed. So I said, we need to be careful about this, but we can talk about things like this at any given time. See, this is called a descending triangle pattern. And sure enough, it broke below it and it just fell out of bed. And that's what we saw on Friday and over the last 2 days. Okay, now it's actually back up, but that's from today, not from Friday. Is it down? And look at Bitcoin. Last I saw, Bitcoin was back below 27,000, not just below 30,000, back below 27,000. This thing needs to bounce back very, very quickly, or we're going to have some problems. Yep, see, it's below 28,000. See that now? So even though it's up $50, it's still, you can see what I'll give it here. But these are the stuff we talk about in that meeting. We go in and I just pull up my Bloomberg screen and we start talking about. Now this is what we're seeing today. Okay, let's go back 4 days. Boom. Okay, see, now here was Friday the 10th. This is where it closed. You can see how much it's sold off. This is where it closed right here. Right here is where it closed on Friday, and it sold off further. So now it's starting to, stabilized a little bit, but you can see it's calmed down. Unless if we just go 3, then you can really, whoops, 3, you can really see again how much it's sold off. This dotted line is where close. Okay, I'm in my seminar. All right. That was my wife. And but I just want to let her know, so there was no problem calling. Sorry about that. I usually don't get the calls at 5 o'clock on a Sunday or 5 o'clock in the afternoon. Anyway, so again, this is what we do on our Tuesday sessions. Talk about this. I don't do it. I thought about doing it on Monday, but then you usually kind of like to get into the week, see if something's happened over the weekend, and then you don't want to wait till late in the week because there's a lot of things can happen that we want to be able to trade off of, and it really gets a chance for people to look at it on a regular basis. So we do it again. We do it once a week, Tuesday mornings, usually at 11:30. I'm going to do it a little bit earlier on this Tuesday. So I can do a little family outing, but it's people seem to have found it very, very helpful and very educational. And that's the whole idea, especially if you're new to it. I mean, if there's a lot of risk involved in trading options, and the best way to do it is ask questions, and you ease your way into it for very, very small trades. Somebody asked in one of these webinars, said, geez, would you ever spend, if you really have a great idea and it's your first trade, should I spend, 100%, bet all my money on it? I'm like, never, don't ever do that. I would never spend, I don't think I've ever spent more than 10% on one trade. It is very risky, but you can, if you start off with paper trades where you're just kind of, looking at it and where you feel more comfortable. And then you really can't get the feel until you actually make a trade, but you can do you can make a trade for $25, and make that trade. And I guarantee you, nobody is a real trader until they've lost money on at least one trade. And as much as can't believe that happened to me, but it makes you, helps you learn, but that you start with a very small amount. I'm not here. That's the big thing here. I'm not here to churn anybody's account. I do not make you do a lot of trades. You do little trades. You do everything. You do all the trades or a lot of the trades that I suggest, that other people in the chat room suggest, or if you do 1% of what we suggest, I don't make any more or less money on that. It has nothing to do with me. And I say some brokers, how it is with nowadays is that you don't have to pay commission for most trades. You do have to pay for a commission for an options trade. Now, if the options commissions are way lower than they were just a couple of years ago, so that's good. But you don't have to worry about me giving you a lot of trades so I can churn the account, because your brokers will want to make the commission, not me. I don't get anything out of it. So, and like I said, and if we lose, we will do some trades to lose money. It does happen. But if you've lost money, I've lost money, and I try to tell you, what are the size of the trades? I mean, because what a big trade is different for everybody. I mean, for some people, $5,000 is nothing. I mean, I lost $5,000, no big deal. Not that many people like that, but there are. So I'll say, hey, this is going to be small for me. For some people, small might be $5,000. For most people, it's $500 or $100 or $50. So I try to keep it small, medium, large, and I say, hey, let's be aggressive on this one. Give you a good idea of what we're trying to do. But that's what I do. Sometimes, frequently, I'll go in and say, hey, I'm just nibbling. I'm going to go tiny in this trade to get started because I just want a little exposure. When I get a real confirmation that we're going to see a big move, then we'll add to it. And so that's another way we play around it. But the point is, there's no question, there's a lot of risk, but a lot of reward. And it's just, it's so far this year it's worked out really, really well because we've had a lot of volatility, and I think we're going to continue to get that.
Hey, just want to give a quick shout out here to our newest family member, Trace. Welcome to the family, brother. Let's go.
Thanks for joining us, Trace. It'll be tomorrow morning. Should be we should get right off the bat. It could be an interesting thing. Now, it'll be one thing. I'm really going to be see what seat we see Monday, because Tuesday could be one of those days, and it's actually a good day for me that I find I'm going to be out. Now, again, I'll be able to monitor everything very closely, especially if things are really wild. I'll just let my sons go on their own. There's plenty of, there's no big deal. And I'll stay in the office. But the point is Tuesday is the day before the Fed meeting. So you might see people kind of sitting back and not, so you may not see a lot of volatility. It might be a day we don't do much. And that's another thing too. If there are days, and then it's happened recently, we had two weeks in May that were just unbelievable. We just knocked the ball out of the park and we're making a lot of money. And then suddenly it was like, things are quieting down. Let's not force ourselves. Sometimes you get, geez, we had a lot of big moves, and therefore we're going to continue to have big moves every single day. And no, that every once in a while, the market doesn't do much. So you got to know when to sit on your hands a little bit. So we've done that in the past. We did that early last week a couple of times. Then we saw the market was a bit
end of May was the best. Well, a lot of people from the chat room, it was their best trading month or week ever. In my case as well, it was the best trades ever. Those past 2 weeks, and your analysis has been spot on. And these retail traders, including myself, we've been able to do pretty well when like everybody else is pretty much in pain right now.
Yeah, it's the whole thing is that I've heard, especially earlier in the year when it is these people on again these financial news anchors, and I'm on them all the time. I was actually supposed to be on Tuesdays, but I had to change it after I got these tickets. I'm going to be on Friday, sometime between 2 and 3 on CNBC. And I was on last week on CNBC early in the morning. That was at 5 o'clock in the morning, and there's Bloomberg TV, and being interviewed by the London people early one morning. This week I'm scheduled to be on CNBC on Friday, a week from, this coming Friday, in the 2 o'clock hour. I'm not sure exactly. They haven't given me the exact time yet, but the point is, a lot of these people are on there saying that, geez, we want to. This is a tough time. The Fed's tightening, but don't worry, we're going to help you weather the storm. That's great, but I'm here to at least hope people, and we've done very, very well. We won't just weather the storm. We want to profit from the storm. We want to take advantage of the storm. They say, emergencies are, you can take advantage of them, and that's what we're doing. It's been working out extremely well, right. Showing you all these trades we've done, and so that's. And the other thing is that when it comes to an end, as they always do, is as much as painful as it is. It's normal. It's healthy. It's what happens in the marketplace. But then what happens when the market bottoms? People are like, "Oh my God, I lost so much money. I'm never going to touch another stock again." And they miss 2 years of a rally. Whereas those of us who've made money are going to have the confidence to buy at the bottom, or at least nibble at the bottom, and then to be adding as it starts going back up. When all those other people, when the market goes up 10%, they'll say, "Oh, here's finally my chance to sell," and they sell, and it'll be like, for over 2 years, not even 3 or 4, but I know over at least 2 years, mutual fund flows were negative for the 2 years following the bottom in 2009, because people were like, "Oh my gosh." That's what happens. They lose so much money when they get the first chance and where the people who've made money, we're going to say, "No, this is the beginning of a new bull market. And we don't mind because we already bought some here. So we don't mind buying a little bit more here and a little bit more there." And suddenly our average price is looking great. And the stock's up 100%. And we're up, and everybody else has been selling on the way up and we're buying. So
right, you've kept always your analysis. And look, since I've been here for a year and a half, I've been following your picks. I remember that all the corrections we had on the way up, you pretty much warned all your members of your trade alerts here and chat rooms always. So you've always been able to warn them so that they can raise cash, go light on stocks, make money on the way down and on the bounce, and even on the, well, if you want to call this the crash, whatever, but you were the one that was talking about this, and big majority of the people were where they still are calling bounces and bottoms and for 6 months. And so, I mean, you've been able to help a lot of retail traders, and like that's what I've seen, at least, when all this happening, some people switch or whatever, but you've been spot on from the beginning.
Yeah, I mean, like I said, at the end of the last year, it was really when I was cautious as we got into the fourth quarter, and then when we got into, well, first of all, it's really mid-November when the Fed was really talking about, hey, we're going to be way more aggressive in tightening, and then I saw the Microsoft CEO, Mr. Nadella, sell his shares, and then but then in December. Then the Fed instead of hinting that they were going to be more aggressive, they're flat out saying they're going to be more aggressive. And then, of course, Chairman Powell confirmed that they were going to get more aggressive in the middle of the month. And I was like saying, raise cash, raise cash, raise cash. This market's going to get, hit hard, don't fight the Fed, et cetera. And all these people were giving all these excuses why that wasn't, they didn't, nothing they had to worry about. And of course, it didn't work out at all. So the thing is, we're going from it's a significant change right now. I mean, these financial assets have been outperforming the economy for a decade, for more than a decade, a dozen years. And that's coming to an end because you can't outperform unless the Fed's giving mountains of liquidity into the marketplace. Will they reverse course and add liquidity back again? If and when they do that, we will change. When the facts change, we will change with them. I guarantee you. If the situation in Russia and Ukraine changes, we will change with it. I guarantee you. But from everything I can see and everything the Fed is saying, this inflation is going to be with us for a while. And in the key areas of, like I said, food and energy are going to remain that way. These assets are going to remain volatile because they are still not down to their real fundamental values, despite what too many on the mainstream of Wall Street try to tell you.
Okay, and a quick shout out here for newest member here, Krithiga. Welcome to the family, Krit.
Welcome aboard.
Right.
Looking forward to seeing you in the morning. Like I said, this is going to be a very interesting week. Tuesday could still be a big day. I mean, I don't know because, but after everything that happened on Friday, with the really, the negative news on the inflation front, also really lowest ever, I believe. In fact, I know it was the lowest ever consumer confidence number. They've been doing this since 1978. It was the lowest number ever. I mean, the consumer is, they keep saying the consumer is strong. I'm like, what planet are you guys on? I mean, credit card debt is going up. Consumer confidence is going down. Real earnings have been falling. 7 out of the 8, they're falling at the fastest rate in 40 years. People, they can't. It's not a tough concept here, okay? If you've got to spend a lot more money on filling up your gas tank and putting groceries on the table, that leaves you less money for everything else. And 64% of Americans live paycheck to paycheck, okay? Again, if you're a billionaire and what do you care? You don't care. That's great. You can fly your private jet to wherever and pay for whatever you want for food. Give a great tip when you go out to dinner. For most Americans, that's not what they can do. They have to spend less money on that. We did have that pent up demand from another year or another winter of COVID, and so we did see the consumer kind of holding in there in the spring. But now that's starting to fade big time. And like I said, even if prices come down, they're not going to come down much because this is a war of attrition. The sanctions remain. The Russian oil. The absence of Russian oil is going to keep oil prices high, natural gas prices high, and not being able to get as much food out of Ukraine and Russia. Ukraine is the breadbasket of Europe. Prices are going to remain high. And if people try to say, "Well, don't worry, we'll get Europe. We'll use these floating platforms that will be able to get them their liquefied natural gas, and they'll be able to." It's like, well, where are they going to get that from? We don't have the capacity to make more. So yeah, they might get it, but they're going to have to take it from somewhere else like Asia. And therefore the supply demand thing will still be there. The supply side will still be low. The demand will still be high. And even though Germany won't freeze next winter, we're all still going to be paying higher prices. And again, a lot can happen. We'll change if it does. But right now, it doesn't look like that's going to change. And stagflation, it's not good for the stock market. Simple as that.
So how did Wall Street and everybody else, all the news places out there, how did they all get it so wrong then this time?
Well, and I've heard me say before that they're kind of, for many of them, they're paid to be bullish. That's their job. I mean, one time I was contacted by a very big money manager, one of the biggest. They said, come on and be one of our strategists. This was a couple of years ago. And it was just an initial phone interview, and we had an interesting conversation. But as we got into it, I realized that and then they said, well, no, your job really is just to make sure to have good, when the markets go through rough patches, make sure that you have good reasons why people should stay in the stock market. I'm like, well, what? I mean, that's not what I do. Luckily, I work at a smaller firm, and they say, Matt, you tell what you think, and that's I say, trust you. If you're wrong, you're wrong. But it's like, you don't always have to be bullish. And that's what these people are. I mean, these, especially economists, they can't, it's not good for, it's not good for your year-end bonus or your job security to call for recession. They never do until after we've already in one. It's already been confirmed that we're in one. And it's the same thing with these people. They're told be bullish. And there was another guy who was at a big firm. He's no longer there, but he's I don't know his own. But he said it's much better for job security as a strategist at bulge bracket firms to be bullish and wrong than to be bearish and right. And so basically that's what they're paid to be, is just to be, and it's like, there's nothing wrong with that in a way, because on a long-term basis, yes, the market does always go up over time. And say, so, don't be selling, but, and that's the thing, that big long-term stock thing, your stock portfolio, that bucket, that's fine. But for the trading thing where you can really not just offset some of the losses in that, but more importantly, make more money, and that trading, you've got to be able to be willing to admit that the market's wrong. But like I said, these firms are, whether they be money managers who are like, hey, we don't want people, keeping their money with us. They don't want to go into cash, which is really not something they should worry about, because if you go into the cash, you usually go into the cash equivalent within your money manager, so that's okay. But the other thing is, of course, is that they want you to, if you're going to work for a brokerage firm, they want your money in their house. I mean, they don't want you moving it out. I'm sorry, but that's what they're paid to do, and they don't mind, because when they're wrong, everybody, when they're, as a group, they're all wrong. So it's like, I don't, that's not true. They feel that comfort. It's like, well, I don't have to worry about losing my job because everybody at Wall Street's been negative. Now, of course, that hasn't been true. I have not been the only one that was negative. Mike Wilson at Morgan Stanley has been bearish almost as long as I've been. So, and he's had some great calls this year. So, but when I give Morgan Stanley all sorts of kudos for allowing to do that, because a lot of firms, they don't want you doing that. They say, worst case scenario, if you really are negative, just kind of, kind of offset it, say it in a way that's nice and not going to be overly bearish. And I've just been doing this too long. I saw what was happening. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. And yet somehow that works really well when the Fed's helpful, but they forget that rule when it's not. How they do that, I have no idea. How do intelligent people? These people are smart people, and it's like, how could they possibly think that we could go from massive historic levels of liquidity and then take it away, and not just phase it out gradually, go to neutral. They're going from incredibly accommodative to very aggressively hawkish, removing it. How could that not have a negative impact on the markets? It is always, every time. And that's another thing. They could say, hey, sometimes when the Fed raises rates, it doesn't hurt the stock market. I'm like, that's just not accurate. Now, sometimes it does there's a lag. Sometimes it can be over a year. And that's what happened in 2000, right before the financial crisis. But that's misleading, because the market hadn't gotten really over extended in terms of valuations. Whenever the Fed starts tightening, when the market is very overvalued, like it was at the beginning of this year, it always goes down pretty much immediately. And so I knew it was coming. It was inevitable. The stock market had been pushed because the Fed kept the level of liquidity, the emergency level of liquidity in the marketplace long after the emergency in the economy had passed. So all these assets, so initially we all knew that they're holding up the market through their asset purchases. But it was like, okay, that's okay, because then eventually the stock will come out of the pandemic and the economy will catch up. Well, the problem is they kept, we had this big gap and it started playing catch up. But they just kept adding, they kept that stimulus, so it could never fully catch up. And we're trading at 22 times earnings. That's the second most expensive stock market ever. And it was the most expensive if you go price times sales, price versus sales, and the price sales ratio, I should say. And, the Warren Buffett's favorite measurement, which is a GDP, market cap to GDP ratio. It's the most expensive ever at the beginning of the year, ever. Okay. So, when you have an expensive stock market and you remove liquidity, especially when you move it dramatically, the stock market had to go down. It had, and I was saying at the beginning of the year, whether we have a recession or not, the market's going to go down 15 or 20%. And that's the thing. Now the economy, so we've done that, but now the economy is getting weaker. Okay. And all those people saying, oh, earnings are fine, they cut GDP forecasts almost in half. since last October, since the beginning of October of last year. Consensus has come down by almost half, and yet earnings estimates have stayed the same. That doesn't make any sense. We don't have to be, PhDs in economics to know that doesn't make any sense. And they say, oh, gee, well, look about the energy stocks. Yes, the energy stocks are going to earn a lot more, and they will make up some of the deficit from other companies, but it's not going to be enough because the energy sector is less than 5% of the S&P, where the tech stocks are multiple double digits. I mean, it can't be made up. So
Right.
This is the second phase of this bear market is going to be more fundamentally based, and there'll be a lot of choppiness now. There'll be bear market rallies. We've already seen two big ones, March and last month. There was also one in February that didn't last long, and we'll see those, and we've been able to take advantage of those. But the line of least resistance is lower. It's just what we have to go through. It's painful, but it's just part of the way capitalism works, and we don't have to be. We don't have to just be punching dummies while it takes place.
Right, so here's a good question then. I mean, what's happening with energy, right? So there's a big demand for it right now, but like also we're converting to green energy, right? So where do you think? I mean, do you think that the green energy plays, the EVs or whatever, the mini Teslas, all those companies, right? Alternative energy. Where do you think that's going to be this year? Like going down with the rest of the market? Or
I think they will, but they will present unbelievable buying opportunities when they do. I mean, the thing is that a lot of them we cannot go to clean energy as fast as people would like. I mean, we all want to get away from fossil fuels. Absolutely want to get away from fossil fuels, but that's impossible to happen this decade. Okay, forget about the next 2 years. People are saying in the next 20 years. I mean, the International Energy Association, the IEA, they came out at the beginning of the year saying we will have the demand for fossil fuels we'll still have, I think it was 85, or maybe it was 90%. I mean, either way, huge. In 2030, the demand for fossil fuels would still be 85% of what it is today. They cannot, the capacity isn't there. So cutting back on this fossil fuel investment is killing us. And we all wish it could happen, but wishing isn't going to get us there. Okay. So I think as the market, and the problem is a lot of these EV companies got pushed up way, again, with that Fed liquidity, it pushed up higher than they really deserve to be. People were thinking, looking at it and saying, this great thing that they're going to be doing in 2035, they're pricing it in 2022. That doesn't work. It's too far out. So again, don't be wrong. These are great companies with great futures, but it doesn't mean that stocks can't come down. I think we'll come down a little more. And I have to do is look at Amazon. Amazon in 2000, the stock, was at top. It actually topped out a little bit earlier than a lot of other stocks. It topped out in 1999, and that stock went down 90%. 90%, even though their earnings skyrocketed and their revenues, both earnings and revenues skyrocketed. They were at the beginning of changing the world, okay? But their stock had gotten so far ahead of itself that it had to come down. Now, I don't think these EVs, Tesla's going to go down 90% or anything like that. But the point is, they got too far ahead of themselves. They're going to need to come down a little bit, and that's going to create an unbelievable opportunity at some point in the next year, maybe next 2 years. But I would think, some point in 2023, these stocks are going to be unbelievable. And it might even be at some point in the fall of this year. And what will happen is that because there's so much leverage in the system, there's more leverage in the system today, well, at the beginning of the year, than ever by a long shot. And guess what? There's more still in it today. You're looking at margin debt, New York Exchange margin debt, which is measured by FINRA. And you can look it up I have a chart here I can show you as well. But it has come down with all this deleveraging, but it still has a long way to go. Whenever the market has to be deleveraged, it's forced selling. People, when they sell, they get a margin call. Doesn't matter if the stock is inexpensive. Doesn't matter if the stock is oversold technically. If they get a margin call, they have to sell. They just dump the stock. And so what may happen is some of these stocks might get what happens is they overshoot to the downside, and they go from being expensive and they don't stop at fair value. They get too cheap. That's what happens to the whole market whenever we go through a deleveraging process. That's just the way it's worked forever. Okay, and you go back long before the United States was here. You go back to tulip mania, etc. Well, that's a bad example because tulips never came back. But what I'm saying is that We saw it in 2003. We saw it in 2009. Some of these stocks just got clobbered, got pushed below their fundamental values, which created unbelievable buying opportunities. And I think that's what's going to happen in a lot of these EV stocks in the next 6 months, and certainly by the next 12 to 18 months at worst case scenario. And it's the same thing with a lot of these cryptocurrencies. The cryptocurrencies are going to go just like what we saw with the internet stocks back in the late 1990s. The ones that survive are going to do incredibly well. But were there 9,000? I think there's 9,000 different cryptocurrencies. I think they're all going to, no. A lot of them are going to disappear. And it's was it Jeff Gunlock? I can't remember. One of the big portfolio, hedge fund managers said, the most successful one might be one we've never even heard of yet, or it may not even been started yet. But they'll come in and I mean, cryptocurrencies I still like them on a long-term basis, but with that Ethereum breaking down below key support, and it looks like that Bitcoin is falling out of that range. It looks like Bitcoin probably has to trade down towards 20,000 before it's over, but that's okay. That's okay for, if you bought it at 60, maybe it's not so okay, but 60,000 that is. But again, it's just something that it's a process we're going through now. It's going to take some while, take some time for it to play out, and but it's one where we're going to be the people who have money. The point is, not only have made some money during this rocky time period, you will also give you confidence. Confidence is such an important part in the investment landscape. Have you the confidence to step to the plate and buy whatever EV stock that you want. Or maybe not. I don't mean just be EV because electronic vehicle. It could be any kind of green energy play that will do very well. So, but it's and as one person said to me once too, is they said, well, wait a minute, if it's not going to work for 10 years or 10 or 15 years, why would I buy it at all? And it's say, and besides, I don't know that I really believe it. I believe it's this or that or the other thing. And I'll go, I don't care what you believe. People are building these things. I mean, if you think we're not going to build windmills and find a way to better control wind energy, things like that, you're crazy, because that's what we're doing. It's happening. We're spending the money on it. We're doing the research. It's happening. So if you're not looking at that, you're making a big mistake. But those people, but then on the other extreme, some people are making the big mistake of not looking at fossil fuels, thinking that it's a dead environment. And of course, they've missed out on one of the biggest trades. I mean, I turned bullish in this group in October 2020, pounding the table, telling people to buy it. And everybody told me I was out of my mind. And then finally, and it's great that the big names came in 4 months later, early in 2021, saying you should buy these stocks. And then at the end of the year, they taken victory laps because they were up 50%. And I was like, that's great. And I was up over 100%. But I'm talking about the ETFs, and even more so in some individual names, whether it be Chevron or even big. That's the thing. When you get the timing right, you don't have to go with some $2 stock that nobody's ever heard of. You can go into a big stock or in the options of a big stock. I mean, we've made a lot of money on Amazon trading, Advanced Micro Devices, Apple Computer. These things, because they have weekly options, you don't have to go to some obscure names. You can go to names that are really well known, which have really liquid options, and they're just trading like May wheat, and it works out really, really, really well. I'm just looking down at my notes here too. It's just, again, we look up. We also, I talked about the FXI. Which was that Chinese stock ETF, but we'll look at the TLT sometimes, which is the Treasury ETF, of course, with the Treasury bonds, and that we see some big moves in that thing. The high yield bond, the HYG, we had one person who bought the HYG calls when it became incredibly oversold. They made 2,500% on their options. Again, it was funny because it was my idea. It's telling people, I said, look how crazy oversold it was. But they went and said, I'm going to go ahead and buy these calls. So again, it's a great community we have. We don't have 20,000 people who are in this thing and trying to do a pump and dump. And that's what a lot of those sites do. They have some guy from a hedge fund come in and say, hey, they bought a stock and they own a lot of it, and so they talk it up on a hedge fund. I'm sorry, on a one of those major chat rooms, the stock goes up and they dump it. They sell the stock to all those suckers that have been buying it up because one hedge fund guy talked them into it. We're not doing that. We're in here giving you ideas. And again, for me, you're getting my exact trades, and I'm not buying them and then talking bullishly so that you can run it up and I can sell it. You know when I buy it, and you know when I sell it. Okay, you get that right from the front. Right
These are exclusive to the chat room, right? These are exclusive, because even though you're on the news and all that stuff, like, I mean,
No, we don't talk about it. It's macro stuff. I mean, once in a while, I certainly will talk. When I talk in the news, it's macro things. And they don't necessarily, and that's what they want me for. And I mean, once in a while, I'll talk, like I talked about recently, where I was saying that some of the stocks that are already finally getting washed out, like a Google, like an Amazon, like a Meta, those are ones I'm saying buy them now, because it's I still think the broad market's going down, so there'll be a little bit of weakness. But I did talk about how people should look at those, buying a little bit of each one of them every single month between now and the end of the year, and just a little bit in here. Don't back up the truck each month. Just, buy a little bit, and by the end of the year, whatever they're going to fluctuate, they're going to bounce around. But by the end of the year, and whenever the bear market bottoms, you're going to have a real nice position in some companies that are they're just going to knock the lights out again. And so those are when I'll talk about specific names every once in a while, but I'm not talking about specific trades, and certainly I don't talk about options trades at all.
Yeah, no, and for the folks that don't know, Matt will typically, actually every single trade, before anything, every single trade, you're going to get an entry, exit, contract.
Yep, we lost you.
Yeah, sorry there. But yeah, basically you get every entry and exit for every trade. He'll tell you if it's a small position, he's building up on it. So, you're basically making every trade with Matt alongside. All you have to do is mirror his trades. You don't need to have 40 years of experience. He's got you there.
Yeah, I mean, it's like I said, I'm not your investment advisor, so you can, it's like, geez, I just don't like that trade, or I'm a little bit nervous about that trade, or it's like, and you say, geez, I like a trade that somebody else is mentioned, and Matt he's in some cases there's ones where like, geez, I like that trade, but I've already got enough money working right now, I'm just going to hold off. Or sometimes like, it sounds like a good trade, but not good enough for me to really jump in it right now. And other people do, and they make money, and I miss. But I'll also tell you, it's like, geez, I really don't like that trade because of this reason. But that doesn't mean you can't do it. If I believe me, if I was right every single time, I would have retired 100 years ago. But I never would retire, because I love this business too much. I'm too passionate about it. But the point is that it's nobody's right all the time, and I'm certainly not. And so it's a. But you do know all my trades. This again, I'm not. If I've not done a trade. I mean, there was a couple of things that I've got small positions that I've just at the very end of the day, right before they expired, I tried to sell them before they went completely worthless, and so I sold them for $10 rather than it's like, so I didn't put those on there, but that everybody knew that they were basically worthless. It was not. It was either letting them expire worthless, or taking a small thing. But any trade of any circumstance, of any size at all. I mean, even very, very small trades, about them. I tell you about them, and when I don't, it's just not what to do. So
you also do like market discussions, like like what's happening in the markets, that sort of stuff.
Yeah, and in fact, we can talk just a couple of things to talk about right now. Of course, we saw on Friday the big sell-off. One of the things that let's see, what time is it? Okay, yeah, let's just look at where the futures are trading, because the futures open at 6 o'clock. Now, it's when 6 o'clock Sunday night is usually not. Oh boy, see, so they're down another. They're down 1% on the Nasdaq future. On the Nasdaq futures, they're down about almost 1% on the S&P, which doesn't surprise me because of how poorly the action was on Friday. I mean, closed on the close. But as I said, where they're trading at 6 o'clock on Sunday night can be a lot different than where they are in the morning. So we'll have to look at them again in the morning. But now, if you can see this here, see that's the Dow Jones futures. They're down 130. That's the S&P futures down 32, and that's down 0.82%. Here's the NASDAQ 100, which is the QQQ, and that's down, again, 157 points, and that's 1.33%. So you can see what they're trading lower here right now. I'm glad we got a chance to look at that, because I forgot that they would open while we were while we were talking. But I kind of got sidetracked there. But the point is, we're constantly adjusting our things, but we want to look at those macro pictures. Oh yeah, that was one of the things I want to talk about. Is that there was something that I didn't realize took place on Friday. Is the MBS, this is I used to know how to talk. The mortgage-backed securities, MBS. That market, I say froze up, but there was some concerns in that market on Thursday. I'm sorry, on Friday. And when you start to get fixed income markets start having freezing up on you, that's when real big things could happen. So it's not out of the question that the market could really get hit hard again on Monday, on tomorrow. We'll see what the news is in the morning. And again, if people can trade the ETFs before the market opens between now and tomorrow, but you can't buy the options until the market opens at 9:30. So we'll see what happens. We do have some negative bets that we put on Friday. At the end of the day, we like I said, we bought some the day before, sold them Friday morning, but we added some at the very end of the day again. And right now they'll make money if the market, but a lot can happen between now and then. The market might be up by tomorrow morning for some reason. So I don't want to play that too much. But the point is, we get, and I'll show you another thing. I want to. You look at the bond market, and oopsie. I mean, we saw what's happening to these. Oh shoot! I'm sorry, that's not what I meant to do. I meant to do this. Oops, this. Okay, hold on. Here it is. Government. Okay, this is yield graph. Okay, we want to go back now. 0, 1. Okay. Oops. 2017. This is the yield. This line is the yield on the bond, on the 10-year note. Okay, so you can see it here, it's 3.16%. And it's almost back to the 2018 highs. I won't draw it for you because it'd be hard to see it on the screen. But see how close it is? It's very, very close. Now, we've already broken above the trend line on this yield, going all the way back to the early 1980s. So 40 years, over 40 years. That's a trend line 4 decades long, and we're breaking above it, okay? And now we're about to make a new higher high. So this thing is at 3.23%, okay? You break above that in any kind of meaningful way, and it's just going to be more problems. It's just going to signal that the multi-decade, it's going to confirm. We already know interest rates have been going up for a long time, right? For 2 years, and really especially since last summer, right? But when you change a multi-decade trend, that's serious stuff. I mean, that is real serious stuff. Let's see if I can show it for you. Oh, and the other thing. So, and let's go back. Let's talk about what next week. What will happen? What are we looking at? I mean, now, if we get hit really hard, then the Fed, they have a meeting. Okay, that meeting starts Tuesday, but it ends Wednesday. They make their announcement at 2:00, and Chairman Powell will be at 2:30 a press conference. And we'll hear more. I mean, maybe he'll say some things. A lot of people think the Fed will get more aggressive, and that actually that would be considered bullish. In other words, that they would raise things by a full percent, the short-term interest rates by a full percent. Maybe that would give people confidence that they're getting more. They're going to get inflation under control, and that could rally the market. And again, we're going to be very, very nimble next week. But you got to look at the bank stocks. People misinterpret. They come out and they say, "Hey, higher rates are good for the bond market." That's not true. Higher rates are usually good for the bond market because usually, okay, the short-term, long-term rates are rising faster than short-term rates, and therefore the yield curve is steepening, and that's where the banks make their money. Okay, the yield curve is. The banks go out and they loan out money, for auto loans and mortgages and stuff at the long-term rates, and they pay it out at the short-term rates, to their depositors. So if that's a big spread, they make more money. The net interest margins that you hear about, NIMs, net interest margins. But if those spreads, if the short-term rates, and then that's when you get an inverted yield curve, then they actually lose money. Okay, they're not. And now that people were. Again, I don't know whether some of these analysts are saying, "Hey, the yield curve is let's say U.S." I'm going to pull up the yield curve right now. The 2-year, what we talk about with the yield curve is, well, there's different ways to measure it, but the most common one is the measurement between the yield on the 2-year note and the yield on the 10-year note of U.S. government securities. And right here, bang, GP, this is the spread. It's going back down. See right here, people saying, hey, it's getting much better. I'm like, much better? What? Yeah, it's improved a little bit, but just on a trading basis, on a short-term basis. You're trying to, how can you say this? It was still trading. Whoops. Okay, I had the wrong thing there. I had the KB. But US yield curve 2Y10. Government. GP, bang. There we go. Oh, it's not coming up for some reason. I apologize. US yield curve 2Y10. I'll try commodity, GP. I apologize here. Now, there we go. See, it's 8. See, that's 8 basis points. And then see right here, they said, oh, it's getting better. I'm like, it got to 40 basis points. It's 40 basis points is really flat. That's not good. I mean, look how far it came down. Okay, this thing's been flattening for a long time. So that little rally was no reason to get bullish on the bank stocks. And now, of course, it's rolling back over and it's about to go below 0, which would mean that the yield curve would be inverted. That usually tells us a recession's coming, and banks don't do that well during banks. So, I mean, I had been bullish. I was bullish on the bank stocks for a lot of 2021. We did very, very well. But I've been, I say I've been less bullish. I haven't been bearish on the group, but now I've become much more concerned. And the reason for that is that look at this thing. Okay, I'm going to get rid of some of these lines because it gets a little busy when I get too many lines on this. But look at this here. Here's the trend line going back to the pandemic lows. And the banks, obviously the pandemic, boom, whoops, I did the wrong thing here. Hold on, KBE. KBE, this is the KBE, which is the bank ETF, okay? Go. Apologize here, just takes a second. We're going to talk about this too. It's a good opportunity to talk about what's called the MACD chart. What we have here, let me get, these are the moving averages. I'm going to get rid of those so you don't have to bother with them. But here we are. This is the trend line going back again to the pandemic lows. Bang. Look at that. We're testing it right there. We're right on it. So if we break below this line, it's going to give us break below the trend line. Remember we talked, now here it's been making, now let's zoom in a little bit. So we know if this line is the trend line, right? Let's see, it's made lower highs and lower lows. It's very basic technical analysis, but I mean, I don't care how you've been the most sophisticated technician in the world. They will be the first ones to tell you that lower highs and lower lows are not good, and higher highs and higher lows are very good. Well, look at this. Lower high, lower low, lower high, lower low, lower high, lower low, lower high. Is this headed for another lower low? Well, it's about to break its trend line to the downside. And if it makes another lower low on top of that, it's not going to be good. And look at it this year. This is what's called the MACD chart. It's something we talk about from time to time when it's compelling. And it tells us, again, that white line, that's that trend line going back 2020. But look what happened. This is the 9-day, the white line is a 9-day exponential moving average and the 12-day exponential moving average. When the 9-day crosses below the 12-day, it's negative. And when it crosses above the 12-day, it's very bullish. Look what's happened. See when it crossed negative there, look what happened to the stock, to the KB. Cross negative there, sold off. Cross negative there, big sell off. Cross negative there, not in a big way, but sold off. Cross negative there again, sold off. It's just made another cross. It's only a minor one, okay? So it could bounce back. If we get a big surprise tomorrow and the market bounces back, this MACD chart is going to be negated. But right now, it's looking like it's going to break down, which means that we are going to get a lower low, and we do not want to be in the bank stocks, at least on a short-term trading basis, even though all these analysts seem to like the stock, like the bank stocks on a longer-term basis. And they may be right, but right now, for the trading purposes for the chat room, for active traders who are looking out a couple of weeks or even just a couple of days, this is something to be very, very cognizant of and be very careful about. And and again, that's where again, I look beyond the fundamentals. I don't want to just look at what the textbooks tell us should happen. Let's look at what's really happening in the world. And what really happens is it's not long-term interest rates that tell you what banks are going to do. It's the yield curve, the spread between the two, the 2-year and the 10-year. And that's what really matters. And then again, this is a momentum thing. When this is like, this MACD chart is like a short-term version of the golden cross and the death cross. A lot of people are familiar with that. The golden cross is when the 50-day moving average rises above the 200-day moving average. They're really both supposed to be rising at the same time as well. Sometimes a cross below a declining one. But anyway, and then of course the death cross is when the 200-day, I'm sorry, the 50-day crosses below the 200-day. So it's when the 200, it's the 50 days, the key one. When it crosses below the 200-day, it's a death cross. When it crosses above the 200-day, it's a golden cross. Obviously, the golden cross is bullish. Death cross is bearish. And that's another thing we do in the chat room, especially on those Tuesday calls. We talk about, hey, that those golden crosses are good for a lot of different stocks, but they don't work well for other ones. And so you need to be careful. And you have to look at history. And you don't have to go, it's not like you have to go back 30 years. You just look at, hey, recent history, this has really worked out well, or it hasn't worked out at all, or it's been very mixed. In the case of here with the bank, with the MACD chart on the KBE bank index, it's been really good. And look at what's happened when it's seen a positive cross. Not as big a rally, but it's seen rallies. There was a rally there, okay. We saw a rally here, okay. But those negative crosses have definitely been bearish. And again, it's momentum. I mean, when the 9-day rolls and increases below 12-day, it doesn't give you, it's not an indicator that, geez, this thing's getting incredibly overbought. It happens a little after the top. And even though it's come down more, you say, well, it's already come down. Yeah, but if you get the negative MACD cross, it's probably coming down a lot more. So that next week, we're going to be looking at some more negative trades in some of these bank stocks. And again, but we'll stay nimble. And if the Fed says something really different at the Wednesday meeting, we can reverse those things in a second and be buying calls and going the other way. So it's next week we have the U.S. Open up here in Boston, but it's going to be the stock market is going to be the thing is going to be really going to give us the fireworks. I think, again, it's every time we have one of these things, webinars, and we talk about, I said, geez, next week's going to be a wild one. And my wife said to me, goes, Matt, you say that every week. And I go, well, I've been right every week. I've been right on every call, but I've been right that the market's been at some wild times. And of course, with the Fed meeting coming this week, there's no question. The other thing to note is that, and this is not, like last week we had the one comment, the CPI, well, the one number everybody was waiting for, CPI. The other thing that could really be come out of left field, as we've already seen with Microsoft and a couple of others, they pre-announced Target. Remember, Target came out after announcing their earnings 3 weeks ago. Then they came out and guided lower again. Wow, that was, and people talked it off. I mean, Wall Street is great. Remember, at the beginning of the year, they were saying, don't worry about the Fed tightening because interest rates are still really low. And I was saying, don't fight the Fed. Don't fight the Fed. Don't fight the Fed. I always said it 3 times. Whenever I write it 3 times. It's like, don't fight the Fed. You can give me all that BS you want, but I'm telling you, it's negative because it always knocks down the market. Always. Sometimes a lag, but it always does. It will this time because the market's expensive. It will happen immediately, and it did. Okay, but they always come up with these excuses. Well, in the Microsoft, it's like, oh, Microsoft, their earnings were bad, but it was really only because of currency. Currencies are part of the fundamentals. Well, so I mean, whenever the internet, the big multinational companies are benefiting from the currency plays, the analysts always say, hey, we have this, or this, and they have the currency in their favor. So this stock's going to go higher. Well, no, but now suddenly with the market, it might be negatively impacted. They don't mention, they say it doesn't matter. Well, which is it? Either it matters or it doesn't. Okay. It's just crazy. And then, this whole thing with Target saying, we're going to have 6% growth next year. I'm sorry, in the second half. Where's that going to come from? Okay, they flat out, they talked about how, they talked around things by saying, hey, the consumer is spending a little bit differently. Yeah. And they said, well, what was one of the main things they're spending it on? This is Target. This is Tenneco. This is what Tenneco said. Tenneco said they're spending all this money on groceries. Okay, now they said a couple of other things like literally cosmetics, but it's like groceries. Well, yeah, well, hello. I mean, the consumer really isn't spending less money. They're just changing the way they're spending it. It's like, yeah, no, they're not spending less money but they're spending so much more on food and energy. They don't have money to spend it on anything else. Okay, you're spending just as much money, but they're spending on a lot less things because and so the consumer is going to be weaker. They flat out said it. This crap about, I'm sorry, but this stuff where they say that it's just consumer taste. It's like, have changed. No. And they say, oh, it's because they bought the wrong stuff. No, what they usually get, which usually sells at this time of year, isn't being sold because people are spending their money on food and gas. Okay. So there's inventory. And guess what? A lot of the inventory has already been bought. Okay. They're trying to get rid of it now. But you know what? How much more they're going to buy? They're not going to buy much more when it gets back because the prices have gone up so much. That was a lot of the inventory building we saw in the first half of the year with so many people coming and saying, we got to get it now because it's going to cost more when we try to buy it this summer for the Christmas season. Well, now suddenly it's like, oh, we shouldn't even have bought that because now we're sitting, now we're loaded to the gills. These are the things that nobody on Wall Street wants to admit to, and they say. So I'm sorry, I got sidetracked there, but my point is that what we could have instead of a specific number, CPI, or a specific thing on Wednesday, we definitely want to be looking for that. That could definitely be a big mover in the market. But anytime we could see a big company say, you know something, we're guiding lower. And that's what happens. Usually we haven't had it in several years because remember during nobody gave guidance during the pandemic, and people understood. And it's like, how can a company know how fast is when's the pandemic going to end or when's it going to ease off? So nobody gave any guidance, and so we didn't get any guidance. Then they finally started giving guidance. But what they used to do in the past is they would pre-announce, a couple of weeks before the earnings to kind of ease the pain if it was a negative, or let people know they like to get their stock up if it's a positive announcement. But they just didn't. They haven't been doing that as much. What they did instead, they gave guidance when the earnings came out. They gave their guidance. Boom, that was it. And they haven't been they haven't gotten the pre-announcements we had gotten in years past before the pandemic. Well, now they're starting to come up, and I think we're going to see more of those in the next couple of weeks because the earnings season starts in July, right after the 4th of July. The next earnings seasons, the next earnings season, a lot of these companies are going to want to get those, like Microsoft just did and Target just did. Get that news out there to kind of ease the impact. It doesn't clobber it all at once, because we saw what happened to some of these stocks when they missed their earnings. They got just shellacked. And so if they can kind of ease their way into it and say, hey, we're pre-announced, it looked like they're going to be a little lower, the stock gets hit. And then when they actually announce, they actually even lower, the stock gets hit, but those two hits tend not to be as bad as the one big flush, like we saw with so many different ones after the most recent earnings season. That's what I think we're going to be seeing. So that could be the real booby traps that we run into, where out of the blue, suddenly in one morning or one evening and then the next morning, where a couple of really big companies pre-announced to the negative side, and people start lowering their earnings estimates for the whole year. And then we got some real problems. And I think that could be a big catalyst. The problem with that, we don't know when it could happen. Where sometimes you can point to, hey, the next Fed meeting, that's going to be a big catalyst, or the CPI numbers, that's going to be a big catalyst, or the next employment report, that's going to be a big catalyst. And we know when it's coming. This is a case where these earnings announcements, or pre-announcements, we will have no idea when they're coming. They'll just come out of the blue. And even that with the specific companies, say, hey, Apple's about to report, their stock's been getting hit. This could be a real catalyst for a nice rally here. We know when they're going to report. We never know when they're going to pre-announce. So that's why we're really going to stay on our toes for the next 2.5, 3 weeks between now and the 4th of July. Again, usually the earnings season, starts about the second week of the new quarter. And you don't get anything the week of 4th of July because nobody's around. So everything comes out. But it's coming. And I think a lot of companies are going to want to pre-announce to get that news out there so we can kind of ease the pain. It's just like what the Fed's been doing for the last 10, 12 years. They're just like, hey, let's let them know well in advance so that they can, they kind of price it in and we don't get a big shocking move. Well, that didn't work so well this time around. But I think companies are going to want to do that as well. But that's here. But anyway, that's just kind of the things. I was just looking at my notes before we got on here. I've pretty much covered everything I wanted to make sure, but talk about. But the whole thing with the Fed is it's been a 1-2 punch. The first was the Fed creating all that liquidity that had to make asset prices come down and meet their fundamentals. Now those fundamentals are starting to get weaker. So that's where we get the second leg. It was kind of inevitable because the stock market is such an important part of the economy ever since Ben Bernanke made it a tool. It used to be in the old for centuries, and certainly for decades, that the stock market was it was an indicator, a leading indicator for what was going on in the economy. Now it actually helps create the moves. Okay, because when Bernanke came in and said we're going to push up the stock market and other risk assets in 2009, 2010, 2011, and that helped the economy better. Well, of course, when they pulled the QE programs away, the market would go back down, the economy would slow back down. So it's become something that impacts the economy. Right? It used to be merely an indicator of what was going on in the economy. Now it's something that impacts the economy. So that's why I said at the beginning of the year, as the stock market comes down, we'll get another leg to the stock market because it will have an impact on the economy. And the fact now that this inflation thing has become much more serious because of the war in Ukraine, everything is, those headwinds have all become much, much bigger. And so I think the market will make new lows. Well, it looks like they may make them on, get below the May lows Monday or tomorrow. It's the people are finally, nobody was talking about this before. I was talking about 20%, 15, 20% correction in December and saying that it could get worse. And again, when you get that unwinding of leverage that has to take place, they get forced selling, and that it tends to push. A market doesn't stop at fairly valued; it goes to undervalued. And in 2018, they pivoted early, but the stock market still went down to 14 times earnings, 14 and a half times earnings. You have to go below 3,400 on the S&P 500 to get to that right now. So these are the things that I think are going to keep a lot of volatility. There are going to be some big bounces along the way. We've been able to take advantage of those this year, and I think we'll be able to continue to do that.
Right,
Rodrigo, I'd say we're doing almost 2 hours or so, but I'd love to get some. I know some people have may have some questions or may have some tickers they want to look at, and I'll be more than happy to look at those. But before we wrap things up.
Yeah, so we have some people here on the YouTube chat. First one from Jane Hammond. If you could do a quick review for a couple of minutes on MULN, I believe on the technical side. Yeah,
sure. Well, first of all, the one thing is that they're talking about this new battery on the fundamental side. Hold on a second. Let me just hit something here, and then I'll get it up. On the fundamental side, they're talking about the thing where it goes 600 miles, new battery and stuff, which would be really obviously a game changer. And what's one of the things that somebody's going to come up with this long-term battery. And if you that used to joke and say, hey, if I could get the stock quotes from, could I get a newspaper that gave me the stock quotes from 6 months from now? Boy, you could make a lot of money. Well, if somebody could tell me which company is going to be the one that in 5 years, whatever, the next year or two is going to come up with that really good battery, that's going to be the one that I really want to own, because they're going to make a difference. But so that's a fundamental. But look at this here. See how it's been bumping up against this 50-day moving average? Let's just blow this up a little bit so you can see it a little better. Oh, let's see how, you see how it came down here? See, 50-day moving average, it was support. And then when it broke, see how it was resistance? When it broke above it, it really shot up. And then it bounced along it a couple of times. And when it broke down, now it's doing the same thing, just in the opposite direction. Instead of, say, whenever here we go. Excellent. No, okay. This is, okay. I can't talk to her right now because we're in the middle of this. But this is a Bloomberg person probably wants a comment from me. Singapore. She's calling from Singapore. Okay. But these are the people, again, I talked to, she's a print reporter for them. I'll respond to them after we're done here. But anyway, okay, so yeah, so old support becomes new resistance, and new resistance becomes new old support becomes new resistance, and old resistance becomes new support. And it goes back and forth. Here we are, right here. That was resistance, became support. Okay, now it's shifted again. But see how it bounced along there as support, and when it broke through, it got hit. Now it's bumping up against it every once in a while. Once it breaks above it, that new resistance, it should run really nicely. So that's really what I'm looking at. Right now, the stock, the 50-day moving average is $1.52. And that's really what but there's nothing wrong with buying the stock right now, but just nibble on it. And then you get the confirmation when it breaks above that 50-day moving average that really would give you the impetus to really jump in. Hold on a second. Let's also look at its MACD chart. And we talked about that a minute ago. Let's go equity. Oops. Let me do it again. I don't know what I did there. Okay, MACD, here we go. Okay, yeah, it's kind of neutral right now. It's kind of, see how it's been bouncing between slightly negative. So it really hasn't been a good thing right there, a good indicator yet. But you can see though, when it gets a really good positive cross, how much it rallied, positive cross, how much it rallied. So we got a positive cross, but it hasn't really turned out. So really I'm looking at right now is that 50-day moving average. To get above that, that's really, I think, what will help this stock get some more get some more momentum. And those algos, those algorithmic traders, they know this. And when again, and whenever you break above a support level or break below, break above a resistance level or break below a support level, you don't just buy 2 or 3 cents is not. You want to be enough where it's a percent or two that then okay, now it's really, yes, it really, it's not just a head fake. This is a real move. So if it gets right now, that 50-day moving average is $1.52. If it gets to $1.55, that's not enough. You want to get $1.70 or something like that. And then you see the 100-day moving average is at 178. That would be another positive move. So that's what I'm looking at on this one, on the automotive, on this EV stock.
Okay, all right, there you go, Jane Hammond. You're welcome, Matt. And Matt does this every day in the chat room. If you guys love this, just imagine being in the chat room with him all day, Monday to Friday, 9 to 5. Green thoughts on the Amazon, asking for Amazon.
Okay, now remember, this thing just split last week, and I just want to talk about this. This was a tough stock to trade in its options because it was a $2,000 stock. Okay. But now, since the big split, now it's trading at 109. Those options have become much easier to trade, much more liquid. And the other thing too is I like to be able to buy more. If you're buying an option with a $2,000 price tag, you buy one option, it's going to cost you $2,000. So now you can buy an option and it's cost you $100, or you can buy more than one. And the reason why I like that is that if you buy one, then you're going to buy it at one point and you're going to sell it at one point. Where if you can buy a couple, even buy 10, buy 5, or buy 20, whatever it happens to be, you can say, oh geez, I'm just going to sell 10 right now. I mean, I own 20, I'm going to sell 10. Let's say, because like if an option doubles, that's great. I own 20 of these things. I'm going to sell 10 now because it's up 100%. I sold half. So if the stock's up 100%, or if the option's up 100%, you spent $200. Well, it's up 100%. So now you've made now it's at $400. I've got a $200 profit. I've made everything I put into it, right? So I've sold half. Everything else I get from now is gravy. Everything else is profit. And then you can kind of let it run. You can be a little bit greedier with that. So I like that. So that's why I like the fact that this stock is this split. But let's go back a little bit. See how the stock was stuck in such a tight range for a long time. Now it's broken down. Now, my feeling, it broke below that range and really just got crushed. Now you're looking at that $100 level. If it breaks below 100, it's going to have some problems. But this stock is, let's see, I'm going to zoom in on a little bit. Sorry. Here we go. Okay. Now it's rolling back over, but so it's not oversold. But I like it on a long-term basis. Let's go look at here. So if it breaks, you see how it had a little double bottom just above 100. It breaks below that double bottom. That's going to pose a problem. But this stock is unlike Apple. Apple is a great company with great prospects. I've never badmouth Apple, but there's a difference between the company Apple, but there's just being a good company, a good stock. AMZN, okay? Look at this. I just want to show you here. Equity GP, okay? This is just a basic price, but let's type in, oops, price earnings. Earnings, bang. There we go. And let's go. Okay, that's not right. That's not right. I got it wrong. But anyway, the stock is become. Look, I apologize. There's something wrong with that. Oh, okay. Well, anyway, this is the level you want to watch. Down right here. It's on a closing basis. You see that it's here. That double bottom around 104, on an intraday basis, about 101. Be careful of the stock. I think it's a great long-term buy. The options, we made a lot of money trading those options around the stock split. That is basically behind us, so that's not going to be a big play. But look for this thing. We're going to look at here, and this is where you want to make a decision. Let's go right here. I'm sorry. Okay, bang. See here. Again, I'm sorry I got so many different lines on this chart, but let's just look at it. Yeah, right here on an intraday basis. Yeah, down about 1, so about 102. If it gets down, but that's going to key. If it gets down below 100, that'll be meaningfully below 102. That's going to be a concern. It's going to cause the stock to fall further. But because the stock has fallen so much more than the other big cap names, I think there's a decent chance it will hold. Now, if we get down to this area with another big sell-off early next week, on tomorrow and Tuesday, and the Fed does something bullish, just something bullish for the market, this stock is going to explode higher. And it's so we're going to stay very nimble on this one. Right now, I'm saying I'm looking at that 102 level. So let's see if it retests that, and if and there's a good chance that this RSI chart will get oversold by then, and it might be a good opportunity to buy it. But I'm going to stay away from it right now. I'd say, if anything, I play it from the short side, but on a very short-term basis.
And for those that are asking, if there's a trade to be made with these stocks that we are going over right now, Matt will basically, if there's a trade to be made, he'll be posting it in the chat room, guys, just for you to know, for the members, right? They already know. Okay, then we have we already talked about Microsoft. Let's hit Tesla. We haven't talked about that from Katrina.
Apologies. Okay. All right, my stand on my thing is, I got a new one. It's getting a little, I apologize that it's getting a little, I'm vibrating the screen there when I'm punching in these things. I apologize. Anyway, yeah, this thing, it got just below, you see how it's been stuck in this range between 700 and 800. It closed, just below 700, but again, not enough to get, but if this thing opens lower tomorrow, it's going to, I think the stock's going to go back and test its lows, to be perfectly honest with you. You see right here, sell off, lower high, lower low, lower high, lower low, lower high. I think we make another lower low. Great. I like this company. I think there's a lot of great things. But this is a kind of a mini descending triangle pattern. So if we break below this kind of a double bottom low, again, it's very neutral on its RSI chart. So that, if it was oversold, I'd be saying, oh, that's fine. Now, but the thing is, if I'm wrong, we'll know it. Believe me, if it can let me flatten this out here. I'm sorry. There we go. If we can, that's much more sturdy. Okay. If it can, dip a little bit here and not fall a lot more, which I think it's going to be tough for that to do, and it can break above 800 and give it a higher high, really change that pattern of lower highs and lower lows and give us a higher high, that's going to be a big change. The stock's going to run. But just the way the market's feeling right now, it looks like it wants to go back down on a short-term basis, retest or even undercut those May lows before it really flattens out. Now, let's look at it on a little bit longer term basis, and sometimes I can get some real good idea of what's going on. Boom, boom. See now, could it get, this is such a key. All these things are moving averages. Now you can see that it just had a death cross. See, well, it wasn't an official one because it's a 50-day moving average, but you really should, to be official, it should be a falling 200-day moving average. The 200-day moving average is rising. And we had a fake one there, but when this one, that's a concern to me. And it does tell you that we could go all the way down to this important double bottom low from last year. Bang, right in here, right? Now let me get rid of those. I'm going to get rid of those moving averages. You can see how the 50-day, the yellow line is going below the 200-day. I'll take that out of there. So that level is, sorry. Oh boy, I don't know if it'll get that low, but it's down near 550. It gets down near 550. It's going to be very oversold. That's going to be a place probably where you want to back up the truck, at least on a short-term basis anyway. And again, go back on Amazon. It's what I'm talking about as a stock. I was in here telling people this stock's going back below 1,000. They told me I was crazy. And they said, how could you say that? Elon Musk is a genius. I'm like, I'm not saying anything against Elon Musk. I'm not saying anything against Tesla. I'm just saying the stock got too far ahead of itself because of all the Fed, what the Fed did. The Fed is removing this liquidity. The stock has to come down. It's just what's going to happen. We're looking at what the stock's going to do, not what it should do. And this stock could be at 5,000 2 years from now, or 10 years from now, or 6 months from now. But right now, with all these lower lows and lower highs, and it wasn't able to make wasn't able to reverse that yet. It looks like it at least wants to go down and retest those lows from late May.
All right, there, good one. And then last one here we have from JT, Nvidia.
Yeah, Nvidia. This is, again, another great company, and there's gonna be a great buying opportunity in this stock. But boy, we had several firms last week. Whoops, let me just do it again. Several firms big firms, Morgan Stanley being one of them, that said that they cut their stance on the chip makers, the semiconductor stocks like Nvidia. And see this again? It's again, I'll get rid of all these moving averages, but again, it's rolling back over. But I want to show you that the best thing here is that, again, remember I talked about that MACD chart? Equity. Now, look at this one here, this MACD chart. Let's see if I can move this down. Especially since the top high, negative MACD cross. Look what happened to the stock. They tried to get a positive cross, couldn't get it. Look what happened to the stock. Negative MACD cross. Look what happened to the stock. Negative MACD cross. Look what happened to the stock. We're now curling back over. Looks like it wants to have another negative one. And this one, see, this negative MACD cross was at a higher one than the last one. This is at a lower level, and it's below zero. That is not good. That is not good. And this looks like it definitely wants to go down and touch it. Probably wants to undercut those lows. I think it's going to go down. It's a great company. It's going to be an unbelievable one to buy when they throw the baby out with the bathwater, either late this year or sometime in the next 6 to 18 months, and I think probably in the next 6 months. It's going to be an unbelievable buying opportunity. It's a great company, but the action in the stock, again, just it's so compelling. Whenever you look at it, again, going back even before the overall downturn, even when it was an uptrend, you see how it had a negative MACD cross, the stock went down. At least it went down some. Now we're in a downward trend. Now let me get rid of these moving averages again so you can see it better. But you can see this downward trend. The MACD cross there. Negative MACD cross there, and it's curling back over. Now, again, we might get a head fake, but boy, something's got to happen the next couple of days to really turn this thing around. Otherwise, we're going to make a lower low in this name, and I want to be playing it from the short side. In other words, looking at the puts in the name.
Right, and folks, I'm just for everybody to know here, I'm going to be showing you guys the chat room with just the format of the trades from Matt, but a big thank you here for Matt Malley, Chief Market Strategist, Miller Tabak, and Lead Trader, Mentor, Educator at the Stock Picks Inner Circle chat room, man. Great stuff today. Good session. And
Thanks a lot.
Yeah, any closing remarks on your end here, Matt? On why
just to say that, we don't have to be, innocent bystanders as the market gets hit. There are ways to, and we've been doing it all year. We've been ways to profit from these moves. We have the tools now, and we worked real hard and as a team in the chat room to help each other indeed benefit. We have some trading options is risky, and we've had some tough days, but we're way up on the year, and it's just it's a great opportunity. It's a kind of a once in a lifetime opportunity for active traders. And it's not going to end next week. It's going to be with us for a while, and which is great. But for those who just, the buy and hold players are going to have a tough time over the next year or more. And I just think that, I'm excited about what we've been able to do, so far in the last year or so. And it's not even been a full year since we started the chat room. I was doing other things, but I just really looking forward to the people. Thank you for those who have joined up. I think hopefully others will look at it. We got a money back guarantee. So if you don't like it a week from now, you can just bail on it. But the whole idea that we try to do is to get people when they come in, you buy, you want to be a really good golfer, and you go spend money on a real good set of new golf clubs, and that's great. but that money's gone. Okay, it may be very good money to spend, but that money's gone. Here, you're spending the money, and you want to be able to make. My goal is everybody you make that money back, the cost of it quickly, and then not only you make that back, but you make more money. And that's what we've done this year. That's what we're trying to do. That's the whole goal. And thanks so much. Good luck, and looking forward to those who have joined already. To seeing you in the chat room tomorrow. And remember, there's no such thing as a dumb question ever. No such thing. Don't worry about that. Ask anything you want. And we're going to have, I think, another exciting week next week and really all summer long. Thanks again, Rodrigo. We'll talk to you real soon.
All right, guys. So right here you have Matt Malley, Chief Market Strategist. This is the live trading room where Matt is pretty much throughout the entire day. I'm giving you a sneak peek, right, of more or less the structure of the trades, right? Keep in mind you have clear timestamps there of the days, right? The exact moment in time when he's buying it and selling it. So this is pretty much real time. It's adjusted real time. Matt is posting here. So in this chat room, only Matt is able to post. You see this channel? There's two channels. This one, Matt's important messages, only Matt can post there. Why? Because in these types of trades, volatile trades, you do want to know, you want to get max profit, minimum losses, right? So if that's the case, then knowing that all of his trades, entries, updates are going to be in this chat, it's very easy to find. You already know what he's already doing. If you're new, make sure you're just reading up on what he's been up to. So and you can set up sound alerts here, right? Let me show you. You see where it says it has like yellow bells. So if you click right there, the bells go away. So it's basically a sound alert. Okay, I have it on my desktop. This is a window that I always keep open. It makes me a lot of money. I'm okay having it open. And all the users as well, from the people that I've talked to that use it successfully, it's pretty clear what they're doing, right? And they're just, basically talking about trades together all day, and it's a community. It's the same old gang from so like this chat room, I think it's been around for like maybe 9 months now, 9 months around there when I started it here with Matt. And I started it from zero, right, with Matt. So then we have about I think about 120, 30 or around there, get a little more maybe, members that are in the chat room. But remember, not everybody is posting there. A lot of people are just reading, following up what they're talking about. But then you can actually ask Matt any questions, interact back and forth, all that sort of stuff. Let's see. By the way, you do have this chart in the bottom here. This one you can just expand it if you want. It's right here. Expand it, open chart in the pop-up, so you do get that charting there. It's free, you don't have to pay for it. The other thing we do have, you guys, is this scanner. It's pretty much unique to Benzinga. We built it, and it's only available to the inner circle for the stock picks inner circle members, right? I'm not saying go buy these or anything. Look, you have gainers, losers. So it can just put a couple of things on your radar, right? Your watch list, right? You can build a nice little watch list here. So this is where you're going to get everything from Matt. You can access the chat room from a laptop, a phone. All you just get on your browser, your Google Chrome, and pretty much this is where you're going to get the entries, exits, all that sort of stuff. So I'm going to post the contact information if anybody has questions. Just reach out, and give me a quick second here to put this up. Okay, so I put the information in the chat on both Zoom and the YouTube. Everybody that joins will get a free laptop. There's a 7-day money back guarantee. It's annual only. It will renew at the same price next year. And the member meeting that we have with Matt in the chat room, it's live. It's Monday to Friday, 8:30 a.m. to 5 p.m. Eastern. And the member session that we have basically is on Tuesday, right? So that's going to be every Tuesday. Let me make sure I put that back in there. Right, so Tuesday, 11:30 a.m. Eastern, right? So that's the live meeting that you have with Matt, just like you had it today, right? So that's going to be for the chat members. You guys will get access to that and recordings as well. You talk about education, trade ideas, all that stuff. And the weekly meeting, well, the regular meeting that you have with Matt live in this chat room that I'm showing you is Monday to Friday, pretty much 9 to 5, right? So if you have any questions, reach out. Thanks a lot for being here, guys. We'll see you next time. And for those, Kriga, all you other guys that did join, I look forward to seeing you there in the chat room Monday morning. So with that said, have a great day, folks. Stay safe, and we'll see you there soon.